I'm happy to be here today to talk to you about hedging, which is an investment position intended to offset potential losses. Now, as I'm going through this presentation, if you have any questions, I've got the question box up in front of me on my second screen, and if I see a question come through, I'm going to stop and I'm going to answer it right away, because I don't want you to be sitting there thinking about your question and not hearing what I'm talking about. So please feel free to type in the question. I'll stop, I'll answer it, and we'll continue on. I've been using this technique for a long time now. I use index ETFs, specifically protective puts, to protect my portfolio during a downturn in the market. The goal is to preserve my hard-earned money. And finally, my technique reinvests the profits made on the puts, because when the market goes down, the puts increase in value. And I buy more stock at the lower value to compound my portfolio. So when the market turns up, and it always will, the portfolio will grow faster, so I may prosper. Now I want to teach you this very powerful technique. And as Renee said, I've been doing this for 35 years now. I do this for a living. I know a lot of teachers teach because they don't know how to do. I definitely know how to do. I do it for a living. However, I've gotten to the point in my career, in my life, where I feel I need to give back. I see so many people struggling with the stock market. It's a fascinating field. Money can be made. I make money, and I really get a kick out of teaching people how to be a success. This technique in hedging is for people with a little bit larger portfolio. Now, I teach option trading, and people can do that with smaller portfolios, about $5,000, $10,000. This is for people that have a little bit larger portfolio, and I'm going to say they ought to have at least $50,000 in their account, if not more. And you might say, hey, I don't have that in my account. That's too big. But you can use your IRA, your self-directed IRA, your Roth IRA, your 401k, as well as your personal account. For your 401k, what you need to do is set up a small account with one of the, I'd suggest one of the self-directed trading firms like Thinkorswim, and trade your protective puts there. Then reinvest the profits back into your 401k. In 2016, my hedging program made $25,000 on a $100,000 portfolio, or $250,000 on $1 million portfolio. This is a very powerful technique. It doesn't take a lot of time. The timing of when you place the hedge on is not that critical. Now, you need to know what you're doing, but I'm going to teach you how to do all that. Again, my name is Dale Brethauer. I've been trading for, got to update this chart, 35 plus years. I'm a hedge fund manager. I'm a keynote speaker with Money Block, Trade Monster, Investor Inspiration, Metastock, The Money Show, Value Charts, and Micro Quant. I've written 3 financial books, and I'm a founder of what I believe is the best stock educational website available today, and that is www.optionsinfinity.com, www.optionsinfinity.com. going to go there towards the end of my talk, and I'm going to show you what we've got available on that website. Okay, this is the outline of what we're going to be talking about today. I want you to fully understand how history repeats itself time and time and time again. I want you to understand what is hedging. I want you to learn a very effective way to protect your capital. And Scott just typed in a question. He says, what downturns? We never have those anymore. That's good, Scott. I like a little levity. I want to talk about how we use ETFs, index ETFs, to hedge your portfolio, how we compound the portfolio using DRIP, which is the dividend reinvestment program, which I've modified. See, the dividend reinvestment program is you take the dividend off your stocks and you reinvest it, okay? Well, we're doing a similar thing here, and what we're doing is we're putting on a protective put. We're taking the profits from the protective put and we're reinvesting it into shares into your portfolio so that when the market takes off again, you've got more shares than what you had earlier. And that's how you really make this thing move. Then I'm going to be talking about the hedging results from last year. And everybody wants to talk about 2008, where I have taught a lot of people who were in the market during 2008, and they lost anywhere between 30 to 60 to 70% of their investment portfolio, whether it was an IRA or a 401k. See, what you got to remember is that most IRAs and 401ks have mutual funds. Mutual funds, by law, must be fully invested at all times. So when the market goes down, they go down with it. You don't have to do that. You don't have to do that. You can use the same technique in your IRAs, and you can use the same technique with a smaller portfolio on the side, protecting your 401k. Now, this becomes very important for those of us that are getting up in age, because if you need your money for some reason, and it's another 2008, you're going to be in a hurting situation. You don't have the time. You don't have the time to wait from 2008 till it finally earned that back in 2013. You don't have that time. You know, the market will rebound and everything, but if you don't have that time, you've got to learn more about this process. Hedging is the only way to protect your hard-earned money. History repeats itself. It sure does. Let me give you a quote from Andrew Mellon, who was the Secretary of the Treasury in September of 1929. Andrew Mellon said, "There's no cause to worry. The high tide of prosperity will continue." This was the Secretary of the Treasury 3 weeks before the market crash of 1929. History repeats itself, okay? 1929 happened, and then people thought, oh, that's it. That's never going to happen again. And it happened a lot of times between that and 1987, but in October of 1987, that market crash caught most economists, scholars, and investment professionals by surprise. Now, most of you probably are aware of that, but how about the tech bubble burst in 1999? How about the real estate bubble burst in 2008? Okay, That's what we want to protect ourselves against. And here's just a chart of the Dow Jones Industrial Average going back, showing you what happened in the market was going up and up and up and up and up and up and up. And this was the .com era, where everybody had a website, everybody had a .com, and they were going through IPOs, and there was no money in the bank. It was all smoke and mirrors, and when people realized that, it started to crash. And then here's the infamous housing market bubble, which turned into a financial market bubble, and down it went. Okay. Now, that was the biggies. That was the biggies. 15 to 20% market drops in the last 20 years. There's been 20 once a year. And I don't know when these come or when they're going to come. I've got a pretty good idea, but I can't tell you now. I don't have a crystal ball. I'm not going to look into that crystal ball and say that we should be hedging because 6 months from now something's going to happen. I don't think anybody can do that. And if they say they can, run, go the other way. But this happens time and time again. It's not just the big ones. It's not the big ones. It's 15 to 20% market drops happen once a year. Well, the thing is, how do you know when that's going to happen? Well, it gets worse. It gets worse. Because market corrections will come. It's only a question of when. Are we on the brink of a market collapse right now? The market has gone up on the quote-unquote Trump rally. And my indicators are saying we're getting pretty close, but not yet. Not yet. Now, I put this little chart together to show you how often these corrections occur. And I'm sorry, the next chart shows that. What this shows is, I spent a lot of time with Dr. Van Tharp, who's a psychologist, and in order to be a successful trader, you really have to check your ego at the door, and you have to have a rock solid strategy that's going to protect you so that you're not afraid. You're not afraid. And I'm not trying to scare everybody out here, but what I am trying to do emphatically is tell you you need to protect yourself from these corrections. When we have about a 5% drop in the market, or maybe less, people say that's a pause. That's a pause. And on a scale of 1 to 10, I'm all right with that. We're okay with that. This happens all the time. All the time. When we have a 5 to 10% drop, it's called a dip. Now the fear factor is starting to increase a little bit, and when we get to about 10%, it's called a correction, and the panic fear factor goes up exponentially. On 10%. We're not talking about the 2008 bubble. We're not talking about the 1999 bubble. We're talking about corrections that happen 10%. And these happen all the time. Now, once you get beyond this, it's kind of interesting because a bear market's defined as a 20% correction, if you will, and the panic, the fear has already taken place. At that point in time, people almost become complacent. If they're still in the market, it's like, oh, I've lost so much money, I can't get out now. So there's not so much panic. And of course, occasionally we'll have the crash, which is 50% or more. And that's the biggies. That's the biggies. I'm talking about protecting all of these. All of these. Even the 3 to 5% pauses. You want to protect them. If you can protect your portfolio and you know it's not going to erode, now you're sleeping good at night, you're building your account. It's why everybody doesn't do this is beyond me. It really is. And now, this is what I was talking about earlier. Usually we have about a 15 to 20% drop once a year. 5 to 10% drop 2 to 3 times a year, and right around 3 to 5% is 4, 5, 6%, 6 times. I don't want you to be fearful. I want you to be a good Boy Scout and be prepared. Be prepared. All right, what is hedging? A hedge is an investment position intended to offset potential losses. The purpose of the hedge is to protect, preserve, and possibly compound your portfolio. And like I said earlier, this is especially true for older individuals who might need their money when the market's down. They don't have the time to wait. Now, here are your choices. You can sell your portfolio in the cash market, but or you can do buy and sell. But the timing there is so critical. And I mean, I don't know of people that can do that kind of timing on a routine basis. I mean, I know a lot of professionals in this field, and timing is a key issue. It's very difficult, very difficult. The other thing you can do is do nothing and observe your portfolio erode and say, oh, ho hum, I've got another 10 to 15 years. It'll be back. It'll be back. Probably it will, but good grief, do you have 10 to 15 years for it to come back? And by the way, if you lose 50% in your portfolio, you have to gain 100% to make up for that 50% you lost. Now, the best choice is to use index derivatives to hedge against that drop in the market. And the best hedging instruments are ETFs, index ETFs. And the SPY is one of the biggest ones that I use all the time. I'm not going to hedge using real estate, gold, bonds, horses, whatever. I'm going to hedge with ETFs, index ETFs. And I've found that the protective puts are the best tool. A protective put is when you buy one put contract which increases in value as the market goes down per 100 shares, or the dollar equivalent of 100 shares that you hold in your portfolio. Now, let's say you hold mostly mutual funds. Okay, you've got to protect yourself on those mutual funds. And what you need to do is look at the value. How much would it cost to have 100 shares of SPY? And right now it's about $20,000. Okay. Okay. So you can take your portfolio that has the that has all the other things in there that you need to protect against, and you're going to buy one put basically per the $20,000 that you have in mutual funds. Okay, so let's say you've got a mutual fund that has $200,000 in there. Basically, they're going to buy about 10 put contracts to hedge against that, and that's not very expensive. That's pretty inexpensive insurance. If it's your 401k, you're going to have to set up your own portfolio on the side to do that. So here we go. September 7th of last year, my signals told me it's time to put on a hedge. What we did is we bought a November, I want to go out about 2 to 3 months. I bought a November 216 put, which was at the money, for $5.25. And I held that all during this garbage. And we finally got out right here, where I sold that November 216 put for $7.99. Now that's not all that much. That wasn't that big of a drop. That was only a 3% drop in the value of the market. Yet we made $274 per contract. And before we were talking about the mutual funds in there. We got 10 of those. You made close to $3,000 on protecting yourself. Well, your portfolio probably went down maybe a little bit more than that. So you pump it back in. You pump it back in and you buy more shares at a lower value. And that's the way you do this. That's the way you do this. Now, compounding, this is something that I used to just do protective puts, and then the dividend reinvestment program I thought was so cool. I looked at doing that for the profits I've been making on the puts, and sure enough, that made a lot of sense. So basically, the money you make on protected puts, you reinvest to buy more shares in your portfolio. You're then losing very little of your portfolio during the market drop, and you're buying more shares, which multiplies your return when the market continues to rise. Okay? Okay? Pretty simple concept. Pretty simple concept. Here we are in 2016. In last year, we hedged our portfolio 4 times. One was right at the end of 2015, and then we got out right here. And then the second one was a very small drop that we hedged. We hedged this larger drop here and this larger drop here. So 4 times. 4 times during the year. I mean, can you do this 4 times a year? I think so. I think so. It doesn't take much time. Now let me run you through some examples here. Let's say on December 16th, 2015, when we first wanted to hedge, we had a $100,000 portfolio. And I'm going to make this very, very simple, and I'm going to say we had everything in the SPY. The SPY at that time was worth $205 a share. For a $100,000 portfolio, then, we had 488 shares of SPY. And my website basically goes through these calculations for mutual funds. It goes through these calculations for NASDAQ stocks, for S&P 500 stocks, for the Russell 2000 stocks. The calculator is going to tell you exactly how many contracts you need to buy. But we're keeping this simple right now. And I always like to round up, and I had close to 500 shares in here. So I want to buy 5. I want to buy 5 February 205 puts at the market at 638. Now, a lot of people, think options are the worst thing you can do, and they are. They are. If you're investing in them, the best thing to do is sell them. The second best thing is to use them to protect your portfolio with, and the third best thing is to have a strategy that gets you in and out quickly to make money. It's very difficult to make money on options, but basically the nice thing about options is I paid $6.38 for this, or $638. per contract. 5 times that, I had to put up $3,190 to protect a $100,000 portfolio. If it expires worthless, that's 3.2% for insurance. That's pretty cheap insurance. Pretty cheap insurance. And we're never, ever going to let it expire worthless. Never. The other interesting thing to note here is that if you're hedging your portfolio and the market goes up, guess what? You're making money on your portfolio, but not quite as much as you would because you have your hedge on. And at some point in time, we're just going to take that off, and then you can continue on. So very seldom do we actually get in a position where it goes against us, but occasionally it does, and I'm okay with that because your portfolio is making money, just not quite as fast. All right, January 20th, we sold that for $19.42. We took that $6,520 profit in our puts. At that point in time, the SPY stock was 185. I bought 35 additional shares. I now have 525 shares at 185.5. My portfolio is intact. Yeah, it's down 3%. It's down 3%, but it's not down 15%. And I have more shares. Okay, second time we hedged was in April. We bought 6 now. We bought 6 because I rounded up here. We wanted to hedge 6. We got the July 209. This was not a very big one. I made $798. Just got 4 more shares. Okay, but we're increasing the number of shares. And that was the very small drop. I think that was only a 2.5% drop in the market. But we preserved our portfolio and made money and made more shares. I mean, unbelievable. In June, we got another signal to buy 6 August 208 puts, and this one went from 612 to 1304. $4,152 in profits on those puts. The stock was at 200. I got 21 additional shares. I now had 544 shares at 200. My portfolio had increased and my shares had increased. Remember, I started with 488. And then the last hedge was a pretty long hedge. I like to go out 2 to 3 months and get these puts, but very seldom does it go out that long. This was a pretty long hedge. This was close to 2 months where we bought 6 in November 2016 puts, and because it was such a long period of time, remember there's time value in the puts, in the options, so we lost a little of that, but we made $1,644 profit on the puts. Going through the same thing, I now ended the year with 552 shares, and then I stopped this on the December 13th of last year. At that point in time, the SPY was worth $226.36. By hedging, I had 552 shares, or 124,950, or a 25% increase, versus, yeah, you would have done fine if you would have just held. If you would have just held, okay, you would have made 10%. I think I'd rather make 25% than 10%. And I had myself protected in case of a bigger drop. We didn't have any big drops in 2016. We did not have any big drops in 2016. Okay. Well, let's go to 2008. Let's go to 2008. And Janke says, do you buy puts at the money? And yes, I do. Absolutely, at the money. At the money, it's got a delta of 0.5. So for every dollar move in the underlying stock, the option will move 50 cents. But you're going to get the most movement when you're at the money. You're welcome. You're welcome. I never go out of the money. And, you know, out of the money is when I usually sell out of the money stocks because there's no, options are made up of extrinsic value and intrinsic value. And the extrinsic value is how, in other words, if you have a put, a 206 put and it's a 200, you've got an intrinsic value of $6. But you probably paid $8 for that. The other $2 is time value. It's the intrinsic value of the option, and it's the time value that you lose. Okay, and I'm going to have less time value at the money than out of the money, because out of the money has no intrinsic value. It's all time value. Okay, 2008. 2008. We almost doubled the shares while keeping the portfolio intact. Okay? You would have started with 658 shares and it dropped to 94. Okay? So that $100,000, that $100,000 portfolio, again, it's not the same $100,000 portfolio I had in 2016, and I was starting the year all over in 2008, and that's how I came up with the higher value of shares there. But your portfolio with doing nothing dropped from $100,000 to $61,852, or you had lost 40%. Okay? With hedging, all the way down, we were making money on our puts, making money on our puts, making money on our puts, reinvesting those in. We ended the year with 1,006 shares at 94. We were down 5%. Not 40%, 5%. Not 600 shares, 1,000 shares. When the market turned around in March of 2009, we were loaded for bear and rode that up with a big bundle of shares. And while everybody was moaning and complaining in 2008, I slept good, I had a smile on my face, and everything was just fine because I was protected. The news media was going crazy. The fear was sky high, and I was sleeping well at night. And so should you. So should you. So how do you learn more? How do you learn more? And Renee, I've got, I probably have about 10 more minutes, so you might want to get the next speaker lined up. I'm gonna finish up a little bit early. I couldn't take the full hour, but thanks for the offer. My offer to you is let me teach you my hedging technique in my recorded workshop. But I'm going to go beyond that, and you can let me do all the work for you to start out with. What I'm going to do is I'll be sending you real-time email text alerts when I believe it's time to put on a hedge. Now remember, I'm not an investment advisor. I'm not a licensed broker. So what I'm doing is I'm sending you a real-time text alert saying this is what I'm doing. You have to make the decision whether you want to follow me or not. You're also going to get a nightly review of the market on my website. And then once a month, we're going to answer all your questions in my once a month Q&A webinar. I'll give you my personal email so you can ask as many questions as you want. Okay? We're going to be going to my website in just a minute. I just want to remind you that past performance is never a guarantee of future gains, and losses are entirely possible. By law, I have to tell you that. Okay, if you join me for the workshop, here's what we're going to learn. 3 powerful indicators and how to set up your charts. And how to set up your charts. The indicators I use, the regression channel, the exponential moving average, and the Fibonacci ratios. We'll go over all the hedging rules. Talk about the timing. It's not that critical. Most times when the market rolls over, you get a slow rollover. I'll show you. We'll go back in history and look at that. Which puts am I going to use? In the money, at the money, out of the money, and how far out, and why? Okay? I don't just put this stuff out here. I research it. I research it to death, and I've used this for years. Which ETFs do we use? An example of formulating hedging for your portfolio, whether it's your IRA, your 401k, or your personal account, whether you've got stocks and bonds, whether you've got mutual funds. We're going to show you how to formulate your hedging and how many ETFs you need to buy to protect that. And we're going to give you various degrees. Do you want to be conservatively protected, or do you want to be aggressively protective? We're going to teach you how to use the website calculator. We're going to go over step by step what we did in 2016, just on one case. And then I want you to fully understand the process. What are you getting here? What are the real-time text alerts going to look like? What are they going to tell you? What's the Q&A webinar all about? It's the first Tuesday of the month, noon Eastern time, and they're all recorded. So if you miss it, you'll get the recording. So it'll be on the website. Then you get a nightly market review. Okay. So what I'd like to do now is just come over here and let me come up here and go right over to the website. And again, the website is www.optionsinfinity.com. When you come into the home page, the first thing you might choose to do is become a free member. Become a free member. And I've got all these canned webinars that are available to you for free. If you don't know much about options, we'll start at Options 101. We'll talk about all these things. We'll talk about some of the technical analysis tools that I use, and the macro MACD, and this is a proprietary signal that I came up with. We'll talk about my different trading methods for swing trading, credit spreads, weekly options. These are all option trading styles. Okay, and then I have three programs. One is Options Pro, and that's where I look at the trading, swing trading and credit spreads. On the SPX, I look at trading just the SPX on a short-term basis. We use the daily chart and the 15-minute chart to come up with trades. We know that the SPX is traded heavily by the big boys, and it doesn't vary from the mean very often. We take advantage of that. And then here's the latest program we're releasing. It's the ETF Hedge. Just come down here and click on Find Out More. Find Out More. And you'll come to this page. This is the ETF Hedge page. We are releasing this February 12th. February 12th. If you want to know a little bit more about it, this is very similar to what I talked about today. These are some of the system stats. The drawdown without hedging in 2008 was 38.2%. With hedging was only 5%. Now, this box is going to come up. If you want to be on the launch list, and we only are going to take a certain number of people in here. I don't like to have huge amounts of people because I respond to your emails directly. I teach the classes. I send out the text alerts. I don't want to do this for a large amount of people. If you're interested in this, and we are launching February 12th, just go ahead and put in your no obligation, first name, last name, email, get the opportunity. You're not only going to be on the launch list, but you're going to get a discount. And you're going to be surprised at how little I charge for this. I mean, well, I like it that way. My marketing people wanted a lot more, and I did not. Here we are in 2016, profit without hedging 10%, profit with hedging 25%. And if you scroll down further, here's the same thing to join us for our launch. Okay, again, the launch is going to be February 12th. I behoove everybody to go onto the website, and what I'd like you to do first of all is you know, become a member. Become a member, a free membership, and listen to some of these webinars. I mean, there's a lot of information here. They're all free. It's going to give you a feel for, do you think you can gain from this information? Do you think this is right for you? And if it is, well, you take your time. That's why, I mean, I'm talking to you today, and we're not launching until February 12th. Take your time, learn this stuff, see if it makes sense to you, and then you know, join one of my 3 programs. You'll be glad. They're all excellent programs. I trade them myself, and once again, I think this is the best website available for education purposes on the stock market today. I think you'll be extremely pleased when you see how little I charge for this exceptional information.